Morning, everybody. This is a seminar, tax seminar for property investors, and it's solely for limited company landlords. This seminar is titled Act Now for the 2023 changes, and we'll be going through what those changes are as the course of this presentation. Hopefully you can see my slides on the screen. Is that the case?
Yeah.
Yeah, see the slides on the screen, great stuff. So let's get into it. Hopefully I can move to the next slide. There we go. So like I say, just to absolutely hammer home the point, this is for landlords that own their properties via a limited company. So everything I say in this presentation will be aimed solely at limited company landlords. Some of what I say may be applicable to sole trader or partnership landlords as well. But predominantly I'm aiming this at limited company landlords, okay? The main bulk of this presentation is going to be talking about the budget changes that were announced in early March, coming into force in April 2023. And this presentation I'm going to circulate to all the investors that have done the incorporation with us over the past kind of 4 years, and they're getting on to 200 landlords that have done that planning with us. So this is going to be relevant for them. I'm going to share a link to this video with those guys. And if you've got any questions, either during the live recording, you'll have a chance to ask them at the end. Or if there's anything, once this is finished being live, feel free to drop me an email after the call, after the seminar, and I'm happy to have a call with whoever to discuss these things. Okay. So before we go into the kind of budget changes, I just wanted to let you guys know the kind of things you need to be thinking about as a limited company buy-to-let landlord, regardless as to whether or not you're affected by the budget changes. So the first thing is stamp duty. If you're buying a new property, you're going to be paying stamp duty if it's over 40k residential, and the 3% will likely apply in a lot of transactions that you're buying through your limited company. Now, your solicitor is not a tax advisor 99 times out of 100, if not 100 times out of 100. Their job is to complete a stamp duty return on every conveyancing that they do. If you look at the contract between the solicitor and you as the investor, the purchaser, it clearly states in a lot of the contracts that they are not obliged to give tax advice or to look to mitigate your stamp duty liability. The responsibility to ensure the right amount, the lowest amount of stamp duty is paid, is on you as the investor. So that's why it's imperative you go to somebody reputable, preferably with a taxation qualification, to get some proper stamp duty advice. It's so common that stamp duty falls between the gaps of a solicitor and an accountant. 99 times out of 100, the accountant is not a specialist in property and doesn't know about stamp duty reliefs and the inner workings. So the things you need to be looking out for are, if the property is dilapidated in any way, okay, and it's not suitable to live in on the day of completion when you get the keys to the property, there may be a chance that you can avoid the 3% surcharge that your solicitor is likely looking to charge you on the purchase, okay? Now, there was a test case on this in January 2019, the Bewley case, and that was quite an extreme example. They ended up knocking down the property. I think it'd been empty for a number of years. It was properly derelict, okay? That created a precedent, but it didn't mean the threshold is that high to qualify for this set of rules. Even properties that are only slightly dilapidated, got a bit of damp in them, and a few other things like that can qualify as dilapidated, and you don't have to pay the 3% surcharge. So keep an eye out for that. Also, actually, there's been a recent case on similar circumstances that's kind of opened the door to another route of how we can claim that dilapidated provision. So if you've ever been knocked back by HMRC on a dilapidated property case and the purchase within the past 4 or 5 years, then get in touch and there might be something we can do, okay? Also, if you bought a property with an annex, there's a possibility that you could claim multiple dwellings relief because there's effectively 2 dwellings. If you've bought a property like that in the past 12 months, there's a 12-month time limit on multiple dwellings relief, then we can have a look at that for you. However, HMRC have got a pretty good record at the minute with cases that have gone to tribunal. There's been quite a few over the past couple of months, and HMRC have won the majority. So there still might be something there, but the chances of beating HMRC are dwindling with every case that they're successful with, to be quite honest with you. 1%. So this is where you've bought a property, normally a flat, normally a shop with a couple of flats or more flats above it. In that case, multiple dwellings relief can come into play and reduce the stamp duty to 1% rather than 3%. So again, something to be aware of. HMRC updated the guidance on that back end of last year, so doing quite a lot of work in that area. If you've moved any properties from personal name to limited company, then, well, my clients who are watching this will know the well-trodden path that we use here. But even if you've just moved one property or a couple of properties to a limited company from your personal name, there's scope to reduce the stamp duty down to 0 on that one. Again, get in touch if you've done anything like that. We can go back 4 years on that, not 1 year. Sub-trust. This is some sophisticated planning that's been not backed by the courts recently. We don't go near it, to be quite honest with you. We just put it on there for completeness. Out of time. If you've bought some of these properties in the categories we're talking about, and it was in the period of between 1 and 4 years ago, you might have been knocked back by HMRC if you tried to do the reclaim yourself, which I know a lot of people do to try and save 20% of the refund. But if you have been knocked back for being out of time, there's still something we can do. We know the magic formula, if you like, as to how to reclaim up to 4 years. So if there's anything like that, again, get in touch. Mixed use properties, the amount of times, somebody's buying a pub and the solicitor has charged them the residential rates of stamp duty, unbelievable, really. So look out for that. Mixed use, the example there I give, pub, quite clearly commercial, but you get my drift. If you've bought from the executors of a deceased person, there is an exemption in some cases. In some cases, I must reiterate that. It's not a case that every purchase from the executors of a deceased person is exempt, but if you meet certain criteria, it will be exempt. Again, get in touch if anything is relevant there. Multiple dwellings relief, touched on that already. And that's all I've got to say on stamp duty for the minute. Capital allowances, again, if you're buying any commercial property, HMOs, flats in a block, then you could qualify for capital allowances. Now, what qualifies? The general rule is setting versus function. If something provides a function, it might qualify for capital allowances. There's a million different rules and it breaks off into loads of different categories. So it's quite complicated. But again, if you bought anything like that, commercial property, HMO, if HMRC have looked at it for you, then get in touch and there might be a capital allowances claim, which brings down your taxable profits, obviously brings down your tax liability as well. Inheritance tax planning, we're doing quite a bit on this at the moment. So you've built a decent portfolio during your lifetime. You want it to go to your loved ones on your passing and not to HMRC. What do you do to avoid inheritance tax? Do you use trusts? Do you use a discretionary trust, income in possession trust, bare trust, EBT? The list is endless, really. Which one's right for you? Any right for you? Possibly not, possibly. LLPs, are they the way to go? Do you qualify for BPR after 2 years of trading through an LLP? Spoiler alert, you probably won't qualify for BPR unless you've got an extreme case. But from these online shows and the in-person shows that I've done for the past 4 years, I don't think I've met anybody at these shows that would qualify for BPR after trading for 2 years as an LLP. But I know other people will disagree about that one. Gifts, straightforward gift out of either income or of the capital asset, could be a way to reduce your IHT liability. And you've got certain exemptions and allowances every year that you can do some simple, basic, cheap inheritance tax planning just to take the edge off. Like I say, guys, that's just stuff you should be aware of and thinking about anyway. It's not really specific to the budget that was done a couple of months ago. I thought I'd share that anyway. Right, budget 2021. I thought it was quite a good budget myself. I predicted that he'd put corporation tax and income tax up by 2% across the board. I was wrong on that one, but looking back, I think putting a 2% income tax charge on nurses when they're getting a 1% pay rise would have been political suicide, so not surprised by that. But it was relatively quiet, nothing landlord tax specific, in my opinion, but we'll come on to that in a minute. Headline really was corporation tax. You know, it was never going to stay at 19% across the board. It is staying at 19% for a small profits rate, but they've brought back the main rate of corporation tax from April 2023, and that main rate will be 25% rather than 19%. So quite a jump, but just as an aside, my personal opinion, I think it's quite fair. The amount of help the government has given the country through the pandemic, they've got to pay for it somehow. And I think, you know, raising corporation tax is probably a sensible one. It's still the lowest main rate of corporation tax in the G7, so still makes us quite attractive, you know, for international businesses. But anyway, I digress. Corporation tax rates, right? The background to this: I started in tax in 2008, and at that time there's two rates of corporation tax. The main rate in 2008 was, I think, creeping up to 30%. It certainly reached 30% for a time being, and there was also a small profits rate as well. I think it was around 20% around the time. And those two rates of corporation tax you know, stayed in existence until 2015. But in 2015, that person whose name I won't speak, George, unified the rates to one rate of corporation tax. And it's still that today, currently 19%, and it will remain that way until April 2023. So what's changing? So notice this word here, broadly, okay, because we're going to go into a little bit of detail in a bit. We're not absolute into the granular detail, but broadly, if your company has annual profits of £50,000 or less, then the corporation tax rate will remain at 19%, okay? If your company's annual profits are 250k or more, then the tax rate will be 25%. Anywhere in between the 50 grand and the £250,000, the main rate will be reduced by what's called marginal relief, okay? Now, the marginal relief calculations are horrible, and as chartered tax advisors used to have to remember them for our exams, and not very nice algebra. However, I broke it down quite simply for the purposes of this presentation. The rules have not been published yet on how marginal relief will work when these new rules come in April 23. However, I think the table I've put down here looks quite nice in that for every 50k of profits being increased, so from 50 to 100k, it's going up by 1.5%. So if your company has got a net profit of 100k in the year to say April 2024, your effective tax rate will be 20.5%, okay? And the thing to remember here, I'm talking purely to limited company landlords here, is that you'll still get, when we work out this profit figure, you will get 100% relief for your mortgage interest payments. So although, even if you're quite a large landlord, and your annual profit is going to be 25%, that's your annual profit is going to be 250k, and your tax rate is going to be 25%. That is with full deduction for your mortgage interest payments. If you're comparing that with having your properties in your personal name or a general partnership, then your tax rate would probably be 40%, or it would be 40% or 45%, and it would be on a fictional increased profit that doesn't take a full deduction for your interest payments. So although a 6% rise in corporation tax rate seems, you know, bad news, and granted it's not good news, but if you compare it to where we are with Section 24 and that disgusting tax that you've got in your personal name, you know, it's still looking all right, in my opinion. And other people's numbers may differ, but These rules got announced 3rd of March this year. We had about 20 incorporations that were going through around that time. Some we fast forwarded and we completed on the 1st of March. Others, we still waited until the 6th of April, start of a new tax year. And I'm probably speaking to a few of them people now. And the numbers we looked at that point, factoring in these increases in taxation going forward, it still made sense for all of those people. I think it was about 12 or 13 who ended up incorporating 6th April. It still made sense for them people to incorporate. Now, I'm not saying that's the same for everybody, but for a lot of people, for people we've spoke to in the past couple of months about this planning, it still works, okay? Now we get on to the nitty gritty, okay? So there seems to be a bit of confusion from some other advisors about when the main rate, the 25% rate of corporation tax might come into play, okay? Now, I might be being a bit generous by saying confusion. It might be scaremongering, but maybe we'll give them the benefit of the doubt. I had a lot of phone calls yesterday and emails from, clients, potential clients, saying they've seen this narrative on a marketing email. And I'll read it out to you. Landlords, open bracket, and all close investment companies, close brackets, will have to pay the full 25% on profits made in their investment companies. Okay. Now let's have a little look and see if that's true, shall we? Because how we're different to a lot of other advisors out there is we're qualified, we're chartered tax advisors, and everything we say, we back up with legislation and guidance, okay? So let's see if that statement there, landlords will have to pay the full 25% on profits made in their investment companies. Let's see if that's right. So the announcement of these increases in corporation tax rates were shown in the TIN, T-I-N-N, it's called the Tax Impact and something notice, can't quite remember. But if you click on this link, it'll take you to it. Oh, and by the way, if you want the slides from this presentation, just drop us an email at the back, off the back of it. And the budget documents do not single out landlords in anywhere in relation to the corporation tax rates. And you can look at those two documents and see for yourself. Now, if anybody has seen any other documents where the government have singled out landlords in relation to the corporation tax rates, please do get in touch. But from what I've seen on the internet, it's just other advisors who are maybe misinformed or scaremongering that are saying landlords will definitely have to pay the 25%. What the documents do talk about are close investment holding companies will have to pay the main rate of 25% on all profits. Okay, so that obviously raises the question, what is a close investment holding company? We've abbreviated to CIHC for the rest of this presentation. Okay, so is your company a close investment holding company? Let's find out. So firstly, before we go into whether or not it's a close investment holding company, we've got to ask the question, is it a close company? Okay, now, if anybody on this call today or webinar or anybody watching this owns a company that is not a close company, I'd be quite amazed, to be quite honest with you. Again, of everybody I met at these shows, online or in person, I think everybody's company would be a close company. And the reason for that is a close company is defined as one controlled by 5 or fewer participators or any number of directors. Now, the vast majority of people I deal with these shows are families, normally husband and wife couples, to be quite honest with you, or with wider family members. They are definitely, almost definitely, going to be a close company. Okay, but that is different to a close investment holding company. Now, the legislation, and I've put it down here because we can back up what we say, Section 34 of Corporation Tax Act 2010. A limited company landlord is not a close investment company if it exists wholly or mainly for the purposes of investing in land for letting, okay? And land in that circumstance includes property, okay? So your limited companies, they exist wholly or mainly for the purposes of letting land and property. So far so good. You are not a close investment holding company. You are just a close company. So far so good. However, a close company will become a close investment holding company if the property is let to a person who is connected with the company or their relative. Again, legislation down there, same section of the CTA 2010. So if your company is letting property to somebody connected to you or a relative, and the definition is quite wide, it does include in-laws, father-in-laws, brother-in-laws. And if you need more detail on that, get in touch after this call, because I've not gone into the granular on this presentation. But obviously, the advice point, and I use advice in inverted commas really there, because it's not formal advice, because you're not paying for it. But a general advice point is don't let your properties from your limited company to your relatives, okay? If you're already doing that, then you've got a few options, haven't you? You could kick them out, might be a bit brutal, but it's certainly a conversation to be had. Potentially transfer that property out of the company, maybe suffer a bit of stamp duty, maybe some corporation tax on the increase in value of the property when you transfer the property out, or take the hit on your profits being taxed at maybe the 25% rather than the 19% tax rate, okay? So it's something to consider. The rules aren't coming in until April 23. So you just need to be aware of this and act, I would say act in the next 6 months so you're well prepared in advance of the rule changes rather than leaving it until the March 2023, in which case, you know, you're probably still going to be stung for additional tax for at least one accounting period. Right. So just to recap, close companies do not pay the main rate of corporation tax on all of their profits. They pay their tax rate is defined by the level of their profits, as highlighted in that little diagram there, okay? If you are a close investment holding company, because you're letting property to a family member or a relative, even if you make £1 of profit in your limited company, it will be taxed at 25%, okay? I hope that's clear for everybody. And just to rewind to that marketing by another firm there, I think it's quite clearly ambiguous at best, and if not, it's just pure scaremongering to kind of put you off having your property in a limited company, which is their whole kind of marketing material, to be quite honest with you. Now, I touched on this briefly in the last 2 online shows, and I don't really want to repeat myself every time, but the reason you go, in my opinion, with somebody who's a chartered tax advisor or a chartered accountant for that point, is because in our code of ethics, you have to be honest and straightforward. That is under the integrity section of the chartered accountant and chartered tax advisor code of ethics. Now, marketing material like that, in my opinion, does not meet those codes of ethics. And I would be very careful about doing business with anybody who's sending out scaremongering or ambiguous text like that to put people off holding the property in a limited company and holding them in maybe another structure. Okay. But anyway, let's move on from that. So what else have we got to talk about with these corporation tax rates? Because being a close company or a close investment company is only one element to it. Okay. Now, whenever I do these seminars in person, there's always at least one smart ass in the audience who would put their hand up at this point and come up with some way of getting around the rules that I've just talked about, okay? And we talked about the 50 grand limit. You know, if your company is only making annual profits of 50K every year, you're only going to pay 19%. Now, I can imagine there's at least a couple of you watching this at the moment who are thinking, well, I'll just set up multiple companies. I've either 1, 2, 5 properties in each company, and each one will get the 50 grand threshold for the small profits rate, and I won't pay more than 19%. Easy, sorted. Unfortunately not. HMRC are wise to this. Like I say, there used to be 2 rates of corporation tax, and people tried it on in the past, so they brought in some anti-avoidance to make sure people don't do that. And these anti-avoidance rules are called associated companies, okay? So we talked about the 50K and the 250K thresholds for the 19 and the 25% rates of taxation. Where a company, and let's say you've got one company that's holding the bulk of your properties, where that company has got an associated company, then the 50k and the 250k rates get cut in half. Okay, you've got two associated companies, so you divide the thresholds by 2. So the 50k becomes 25k and the 250k becomes 125k, and so on and so forth. So that raises the question then, what is an associated company? Well, the definition of an associated company is at the time or any time within the preceding 12 months, and I've underlined that preceding 12 months because it's important, one company has control of the other. So you've got maybe your property company that's got a subsidiary where it owns 100% of the shares, or both companies are under the control of the same person or groups of persons, okay? So kind of applying this to my standard client, that would be, you've got your property company, it's owned by, you know, a single man, say. And let's say that single man also has a manufacturing business, completely unrelated to the property. He controls both of those companies. So he has 2 associated companies. So those small profit rates would be divided by 2 in that example, okay? Another example is whereby it's a husband and wife owning 50% of the shares in the property company. And let's say, real world example, the wife owns a beauty company in her personal name, okay? Now, because the wife has control of 2 companies, the scope that there would be 2 associated companies, and the property company would have its 50k and 250k thresholds, okay? Now, when we're talking about control, we're not talking about directorships per se. More broadly, it's about the voting power that a person has over a company and the shareholding. There's a couple of other points around loans and debentures and stuff like that, but it's probably not relevant to a great many people on this call, okay? Now, control of other companies via spouses is only relevant if the companies are interdependent, okay? Now, again, the rules on this are quite, you know, quite difficult, complex is the word I'm looking for. Yeah, quite complex. Now, going back to the example where you've got husband and wife owning a property company together, and the wife owns her property company on her own, she owns 100% of those shares. The way to get around that potentially and get some proper advice on this is for the husband to become the 100% shareholder of the property company, and the wife just to be the 100% shareholder in the beauty company. Now, because the 2 companies, I imagine, will not be intertwined or interdependent, because there's absolutely no connection between them, in that instance, the 2 companies would not be associated. So the property company would still have the full 250k and 50k thresholds when calculating its corporation tax rate. Now, true dormant companies, and by dormant, I mean the company does not trade, it doesn't hold any assets. Maybe it was a company that was set up for an SPV that either never got off the ground, or you sold the SPV, liquidated the cash out of it, but the company's still in existence. That dormant company does not count towards the associated companies. If something changes and the dormant company starts receiving some income or buying an asset, then it may become an associated company. So it's just that's just something to be aware of. And likewise, a true holding company, and by a true holding company, what I mean is a company that sits above one or several other trading or investment companies, and its only purpose is to receive dividends from those companies and pay it to the ultimate shareholder. That will definitely not be a associated company in that example. If it starts lending money to the companies, it may or may not become an associated company. But that's just a conversation to have if that's relevant to you, to yourself. So general advice point 2 is consider which other companies you, your spouse, your family members may have control of, and then work with somebody to ensure that these don't become associated, so that you're not reducing those tax rate thresholds when the rules come in April 23. Okay. And again, this must be done by April 22 at the absolute latest, because just running back to the definition of an associated company, it talks about the preceding 12 months. So if you've got an accounting period that starts in April 23, when these rules come in, you've actually got to look back to April 22 and see if there was any associated companies in that time frame. So, you know, we're getting on to, it's less than 12 months until April 2022. So that's why the title of this seminar was Act Now for these changes, not act in February 23, because it'd be too late and you'll be, you know, annoyed at your accountant or tax advisor because you've not been told in time. Well, you're getting told now. So you need to get your skates on. And if you even potentially got a problem, then get in touch. We'll have a phone call, look at a bit of detail and see if there's anything that needs to be done for you to, you know, not be adversely affected by these new rules. So that's me, that's my email address. If anything in this webinar so far has been of interest, if you've got any questions off the back of it, feel free to drop me an email, put your name and your number on there. In these situations, it's usually best to have a call initially rather than go back and forth over email. And yeah, so let's have a brief email to begin with. We'll set up a call and we'll take it from there. So I'll leave my contact details on there for a little bit in case anybody wants to take a note of them. Like I say, if you want the slides as well, then drop me an email. Happy to provide them. Now, we've had a few questions in the chat section that Becky's kindly passed over to me. So I'll just answer a few of them while we've still got about 10 minutes before the finish. So first question, what is BPR? Sorry, cardinal sin of using too much jargon there. Sorry about that. So BPR is business property relief, okay? It's an inheritance tax allowance that can apply on, you know, transfer of assets, either during lifetime or on death. There is some people touting that forming an LLP and running your property portfolio through an LLP, a mixed partnership, hybrid partnership, will, you know, mean that BPR is available after 2 years. I've got massive reservations about that, mainly because of Section 104, 105 of the Inheritance Tax Act 1984. If your property is mainly or wholly made up of letting property or making investments, BPR isn't available. That's my opinion and the opinion of every other chartered tax advisor I've spoken to about this. So we don't offer that. I'll just add in as well at this point that I did some videos with Vanessa Warwick of Property Tribes last month. They're on our YouTube channel, getting into the 21st century, some YouTube videos. And we talk about kind of structuring, inheritance tax, stamp duty, capital allowances in a bit more detail. So feel free to go and check them out if you're interested in any of that. Next question, if remortgaging on a deceased property and deceased has second charge on property, would purchaser be liable for second charge? It's more of a legal question than a tax question. So who do we know who's legal on the seminars? Paul Champolina might know. He's a good guy, Landlord Action. If not, Legals for Landlords are quite a good company based up here in the Northwest. By all means, get in contact with them. Somebody's requested a copy of the slides. Drop me an email after this webinar and you can have a copy. And it seems like that's it. So I hope this has been useful for everybody. Like I say, get in contact if there's anything that you want to talk about in a bit more detail. And if you're one of my clients who has been through the incorporation process or the partnership process, then I'll be sending a link to this video to everybody. And if you've got any questions about how it affects what we've done or what we're planning on doing, just drop me an email. We'll set up a call and we'll take it from there. All right. Thanks very much. I'm going to try and stop this now. So stop my share and stop in video. Thanks very much. I hope you enjoy the rest of the event today.